Good morning, everybody. It's Dan Kautz.
Good morning, Jeff Buckley.
And here we are, October 2025. Time is just moving on. It's really something. We've had a lot going on in the markets. It's really more not in the markets. Markets have been responding pretty well to this government shutdown.
They have. That's
and,
true.
I know that's something we want to touch on here.
Yes.
So
We're going to go over that a little bit.
yeah, without any further ado. And, we did talk about you dressing up as a Halloween costume. Did it work this week?
Not this month, no.
Okay.
I'll dress as a pilgrim next month.
You heard it right here.
Yeah.
Okay. All right, so let's move forward on the slides here. There we go. This is a quick check-in call. It's something we do every month, as you know. We can't take any text calls or during these, or live calls, texts, or chats during the recording of this seminar or this webinar, excuse me. Our contact information is dkautz@kautzbuckley.com and jbuckley@kautzbuckley.com. Our phone number is 716-276-8480, and the ever-popular text line is 716-272-1129, and we just want to urge all our clients to remember, text us at that number. We cannot take texts on our personal line, okay? That's a compliance violation. We really need you to get a hold of us on the text line, and it has been very successful.
Yes.
It's just I ask some of our friends that might ask us a business question while we might be having a social conversation, crosses the line, right? So please, if it's a business question, you want to text us, right on the text line right there. Okay, enough of the compliance department. Disclaimer right there. Let's move on to the charts. Jeff, take it away.
Yes. Well, this is as we begin here, this is our look in the rearview mirror just a little bit and see how the month of September was. And really, because end of September is the end of the third quarter, so we also get a chance to kind of look at our month to date, quarter to date, and year to date too. So kind of a summary of where we've been so far in 2025. And honestly, it's been a pretty good year.
Yeah.
You can see the month to date. Traditionally, I know we talked in last month's webinar, traditionally, September is a difficult month for the markets. A lot of pullbacks. Historically, it's one of the worst months out there for performance, but we really had a very good performance, especially still in that tech-heavy NASDAQ. Still did very well. The quarter itself finished strong also. And year to date, I mean, we're looking at pretty substantial gains so far, really across the board. I mean, even the mid cap 400, which we bring that up, that's a kind of a mid-sized company index, but it's very specific to the companies that fit that sector. But even that's up a little over 5.5 or about 5.5% so far this year.
And
so
we keep saying that because it's usually the mid caps that would feel the pain first,
right.
Yeah,
Yeah,
they can't get lending or
Yes.
unemployment or their job losses or job reports come out. Not reports, but the first hit of job losses
Yes.
may be in the mid caps.
That's right,
large
and the
caps.
small caps too,
Right,
which again is kind of captured by that Russell 2000. But again, that sector's done pretty well also, again, with the start of the Federal Reserve cutting interest rates, which is seen as being very favorable to those smaller companies. We've seen some positive numbers there too. We're still, at the end of September, we were still off a little bit from our all-time highs, but not significantly so. So we're very close to setting records. I think we've set a number of records this year so far.
Yeah.
So.
In light of everything that's happened so far.
Well, and
August,
just this
September.
last column, I just thought this was interesting too. I mean, this goes back really to probably, I'm trying to think, we had some at the end of 24, some lows, but then also when the tariffs were announced and the markets took a significant drop. But since then, just the 52-week low. So that's looking back just one full year through the end of September. We're up significantly from there. So certainly we've recovered the losses and then moved much higher.
So all right, well,
Yeah.
so far so good.
Yeah, so we've got this is just a quick look at some sectors. We just like to focus on this because again, technology is really kind of leading the way, although communications, which, we've got Alphabet is in there, Google, they fit in the communications category as well. So it's still a very high-tech sector, but those sectors have certainly been leading the way. Really the laggard staples, consumer staples, those are the kind of companies that they are probably feeling the most effect from the tariffs. Those are, the production things where they need to try to pass along cost increases that the manufacturers are experiencing. They need to pass those on to consumers, but their margins are pretty thin on a lot of the products they produce, so they can't do that as efficiently as maybe some in the technology or communications sector.
Here you got to go to the store and buy something, right? Here you push a button and get it delivered.
Yes,
a little
that's
different.
right.
So
so that's it. Now, this is our slide where really what we're trying to just show everybody here is we understand certainly none of our clients have a portfolio that's 100% stocks, which would be extremely aggressive, or 100% bonds, which would be extremely conservative. So we like these numbers that come from Morningstar, and we just show you these because it tries to give you an idea of how your portfolio might be. If you're a little more on the conservative side, you may be somewhere around a 50-50 allocation between stocks and fixed income or bonds, or maybe even a little bit less than that in the stock area. So this will kind of give you an idea how things have been looking for a little closer of a read towards your portfolio here. But again, return year to date, even the most conservative portfolio up here, model portfolio, is still almost a 10% return year to date. And the 12% return, we still are taking into account the 12-month. I'm sorry, we're taking into account some of the downturns we had a little bit over the last 52 weeks here. But again, we're still in positive territory. The one thing that I thought was interesting, and I ran these numbers as of October 6th, the thing that I found most interesting was this is the 3-year column here. Yep. And we've talked about that significantly over the last few webinars. This really increased because what we're starting to see now is the year that was a very difficult year for both stocks and fixed income or bonds. That year is starting to roll off because now we're close to the end of 25. So we're only looking, when we go back 3 years, we're only looking at returns starting in October of 2022 forward.
Which was a rebound.
Yes, it was. So you can see that year had a significant effect on everyone's portfolios, whether you were a more conservative investor or a more aggressive investor, because it affected bonds as well. But we're starting to see much more positive numbers here looking back 3 cumulative years. The 5-year return, though, however, still includes that year, and we still got one persistent negative number on there in a very conservative 20% equities, 80% fixed income portfolio. If we go back 5 full years, we're still a little bit negative. Not a lot. I mean, we weren't necessarily losing lots of money, but we weren't, as we've talked about before, we weren't staying ahead of the rate of inflation, and we weren't maintaining that purchasing power. So. But again, we're moving in the right direction here. So these are some nice numbers to look at.
And it's great.
Yeah, it really is. So
I'd like to point out, I think we got one more extra green on here. We only had 3 last month.
Yeah, I think you're right. We've got 4. So this is, again, now we're looking out the windshield here. This is our look into the future and what's coming up next here. This is City National Rockdale speedometers that we reference every month. And this is a look, 6 to 9 months down the road. And Dan, we always look immediately for the red, yellow, and green.
As we all do.
Yeah, exactly.
Do I speed up and go through it? What do I do?
That's right. And we've got another green that we've got credit demand and availability just jumped up. So again, these are all very specific sectors, but the goal is to try to give you an idea of the different sectors that really make up the overall economy. What's doing well, what's caution, and then what we're still struggling with, which again is geopolitical risk, and we've got the equity market valuations too, which are still extended. They're still pretty high at this point, but overall, a pretty positive sign.
I keep bending over because I think the secret's out. It's like when you catch that big fish and you put it closer to the camera. Well, in this whole thing, I'm the fish. So I've been trying to back up a little bit. So, but the thing of it is, I got to lean over to look a little more. And if you look at the consumer spending, I know it's still yellow, but it's been ticking up, this is a good sign, even despite some of the job layoffs that we talked about last time we were together.
Right.
So the consumer spender, the American consumer drives this economy.
Yes, most definitely. Yes.
This is the thing that's given us, we're still feeling pretty good.
We are. Yeah, things are looking pretty good. Really with on the inflation front, inflation is persistent, but it's not necessarily increasing significantly at this point, which would give the Federal Reserve pause where they might think that they need to start hiking interest rates again. We're not really seeing that. We're seeing that it's sticky. It's not coming down as quickly as they would like, but it's also, it's kind of maintaining the status quo a little bit. So the Federal Reserve has tended to focus their attention more on the labor market, and that's where we are seeing a few cracks out there here and there. But again, it's not a lot of layoffs yet, just not a lot of hiring going on either.
Right. It seems a little stalled.
Yes.
Maybe.
Yes.
And it would be interesting to see what sector. Is it the hourly employee? Is it the CEO, the C-suites? Is it the mid-level management, which is more than likely this place we're going to start seeing some cutting right in that area. You ready?
Yep,
I got
ready.
Permission to move forward?
Yes.
Thank you, sir.
Full speed ahead.
All right.
But then we did, obviously, one of the biggest issues that's going on right now is the government shutdown. As we record this, the government is still shut down. And to be honest, I think we're anticipating that it's probably going to be shut down at least several more days beyond this. There's talk at this point that, that first paycheck that will be missed by military service personnel, TSA,
we've been flying a little bit this week.
Yes, that's right. Yeah, we've had to worry about that a little bit,
Air traffic
too.
controllers, we want to make sure those people are happy
Yes.
and in their jobs.
Yeah, so we thought we'd just touch on this. Really, what does this mean to your portfolio overall? And, we thought I'd start right out and hit it on the head here. Historical data shows shutdowns don't derail portfolio growth. They do have an effect, but it tends to be short-term as well as with a short-term shutdown of the government. Now, obviously, the longer this persists, the more difficulty it's probably going to cause, the more consternation out there and it might start to have a longer-term impact on portfolios. But for now, generally speaking, these government shutdowns, and we've had a number of them, they've been relatively short-term, and the impact on a long-term investor's portfolio has been minimal.
Now, the longest shutdown I was reading this morning was under Trump 1, when it was like 35 days, I think.
Somewhere in that neighborhood,
area.
yeah.
Hopefully, we don't hit that length again.
Right.
But it's still, we did okay.
Yeah, I think it kind of shows the longest. This was just a chart, but this was kind of interesting too. That what it's showing really is this is the S&P 500 return during the government shutdown. So yeah, we've had some difficulty with it during a couple of the shutdowns, but nothing really more than about a 4% decline, which honestly falls really within the realm of a kind of a normal
day
pullback.
at the office.
Yes, in the markets, yes. But we've also seen some positivity. Nothing where this is a reason to jump in and invest because the markets are going to take off, but something more akin to just we've just been able to get through it. We're treading water. We're looking at other factors beyond the government shutdown itself. 11 positive returns, 9 negative returns. But there have been 21 previous government shutdowns. So this
1976, huh?
Yeah. So this is not something brand new here. So you can jump to the next one here. Now, again, I know there's a lot of information on these graphs. They're kind of busy. But the point, the threat of a government shutdown often makes headlines, but the market tends to ignore the excitement. Right. So that's really what it comes down to. The markets tend to stay focused on factors outside of the government shutdown. They don't necessarily worry as much about the politics, and instead they're looking at the overall economy. So that's a positive chart, really. Just a couple things here, and again, I don't like to put a lot of stuff up here to read, but just a couple bullet points that I thought really kind of hit home. According to the Morningstar data, Morningstar is a unbiased source that we draw a lot of our information from. The average one-year return after a U.S. government shutdown has been nearly 18%. So again, a positive statistic, with the market positive about 90% of the time. So again, if we can stay invested, weather the storm through the government shutdown, there tend to be positive returns.
Don't let emotions take control here.
Exactly.
Time in the market.
That's right.
Not
timing the market. That's it. During the shutdown periods themselves, returns tend to be modest and often flat, which is kind of what we've been experiencing for the 7, 8 plus days that we've been shut down currently. So this suggests that even though shutdowns generate headlines and anxiety, markets tend to look through the noise and refocus on fundamentals. So, and then the last couple slides here, we just thought we'd touch on 5 points here, really. The duration of federal government shutdowns is historically short. We don't know, again, as you pointed out, Trump's first term also experienced the longest government shutdown. And this one, unfortunately, where we stand right now, today, doesn't look like there's a lot of conversation going on in an attempt to work things out. So we don't know. This could end up being one of the longer ones, if not the longest one. But the majority of shutdowns last only a couple days or a couple of weeks. So usually that's not enough to disrupt the structural economic trends which the market is really focused on. Most federal government spending and obligations do continue. You know, you hear the term a government shutdown, and it makes you think that everything's going to come to a grinding halt.
The street lights aren't going to work.
Right, exactly.
You know?
But it's really more, you know, many federal obligations, which are debt payments, Social Security benefits, previously appropriated contracts, which include a lot of contracts with the federal government that affect many different sectors. They're really unaffected by a temporary lapse in the discretionary funding. Markets are forward-looking. You know, investors are pricing in what the expected risks are, and once the uncertainty is resolved, the markets tend to revert back to fundamentals, which is what the markets have been doing over the last week, 10 days here. It's focused on earnings, interest rates, and growth, and those remain pretty positive at this point. Volatility versus trend. You know, shutdowns, they may increase the short-term volatility, and we're experiencing that a little bit. We're seeing some ups and downs in the market. Yeah, but not really the long-term return paths, because those are focused more on those fundamentals and valuation dynamics. And then the last point, really, the historical record supports the resilience. As the data above shows, equities have recovered post-shutdown in the vast majority of cases with strong returns over that 6 to 12 window following a government shutdown. So, you know, what we're preaching to everybody is let's stay, the underlying
data.
Yeah, the underlying data is very positive. So let's stay focused on that. We'll get through this government shutdown, hopefully without much, if any, real significant damage.
Yeah, hopefully, and I believe that's true.
Right,
I do believe that's true. Now, I remember you and I talking when the shutdown was announced and we were coming in, we were going to do a special webinar.
Yeah.
And I haven't received one phone call from a client nervous about this.
Well, I haven't either, to be honest with you. And
that bodes well to our clients to understand.
Yeah.
Follow the data, stay invested.
Well,
don't get emotional.
Dan and I happened to be at a business trip, actually, through AssetMark, one of the companies we look, and they had money managers there, and it was, the conversation was not even focused on the government shutdown.
Yeah,
and a few people asked questions of the money managers, and they said, they basically had this data that we've just reviewed with you, and they said, doesn't really mean much. You know, we're still focused on those underlying economic trends and data.
When we say it doesn't mean much, it doesn't mean much to the market.
Right.
But I got to tell you,
right.
We have heard some rumbles about my health insurance premium.
Yeah.
You know, that's popped up yesterday, today, and now that may be a budgetary thing that comes home to people's dining room tables.
Right.
Okay, the market's doing well. Let's just pay attention to how our budget's doing and what's going on there.
Yeah.
But other than that, please don't act emotionally. Stay focused. Give us a call. We're here for you. You know, again, we have Matt, who's just joined us a couple weeks ago, Matt Andrzejewski. Kristen's right here all the time. You got Jeff and I. Give us a ring. Let us talk things through. But overall, hold tight. We're looking good.
That's right.
So I want to wish everybody a happy Halloween. We look forward to Jeff being a pilgrim.
Yeah.
I don't know how that's going to turn out, but I'm anxious to see. So have a great month. See you later, guys.
Thank you.